This edition of PKF Hotel Horizons Market Update with Mark Woodworth is brought to you by Hotel Horizons and Annual Trends. Hotel Horizons is the econometric forecasting product that PKF produces for 50 U.S. markets as well as the nation as a whole. Forecasts are created for upper price hotels, lower price hotels, 12 national chain scales, and locations. It includes econometrically derived forecasts of occupancy, rate, RevPAR, supply, and demand on both an annual and quarterly frequency. Annual Trends is PKF's survey of over 6,000 U.S. hotels where detailed financial data are compiled by region, property type, and room count. They are used to provide hotel owners and operators real benchmarks for their property performance.
Good day, I'm Mark Woodworth, President of PKF Hospitality Research. I'd like to take a few moments and share with you some of our current insights with respect to local market behavior across the U.S. in the year ahead. Data from Smith Travel Research reveal that many cities across the United States have already begun to experience very favorable year-over-year increases in demand. According to STR, in the fourth quarter of 2009, 30 of the top 50 markets that comprise our Hotel Horizons universe experienced year-over-year increases in total rooms sold. That number increased to 49 markets during the first quarter of 2010. So clearly the recovery that seems to be taking hold in the U.S. is becoming very pervasive. As we look across markets, and importantly understanding that while demand is critical, its ability to help affect rate growth is clearly a function of the balance of supply to demand on a market-by-market basis. Here we show our current estimates as to when we believe RevPAR levels on a quarterly basis will turn positive in the quarters and years ahead. As shown on the map here, some communities have already begun to experience increases in RevPAR, while others are not expected to turn the corner until well into 2011. Now, for further analysis of leading and lagging markets, I turn to my colleague, Aaron Walls. Aaron?
Thank you, Mark. I'd like to focus on a set of scenarios for today's piece. As we know, the lodging industry is cyclical in nature, and timing from an investment standpoint is crucial. What we know from the past does not always transfer into what will occur in the future. So let's take the following example. If we were to invest in the top 5 RevPAR growth markets from 2003 to 2008, we would get the following list. Now, after everything that happened during the financial crisis, how did these markets look over the next 5 years, from 2009 through 2014? Not as good. In fact, only one, New York, remains in the top 5. So let's apply another twist. What happens if we invest in the bottom 5 RevPAR markets from 2003 to 2008? You will see a performance spread that's nearly identical to the top 5 from the same period of time. This means that we cannot rely on historical performance as a predictor of future movements. We have to focus on the economic fundamentals that underlie each market to provide us with a clear picture of what will occur in the future. Back to you, Mark.
Thank you, Aaron. With favorable prospects for demand growth occurring across the vast majority of U.S. markets, thus suggesting increases in average daily rates are likely around the corner, our thoughts now turn to profitability. As we show here, over the long-term history, there has been significant variation year to year in unit-level net operating income. Citing data from our annual Trends in the Lodging Industry effort, the typical U.S. hotel in 2009 experienced a 35.4% decline in NOI as compared to 2008 realized levels. Given our current outlook, which calls for significant increases in demand and occupancy, but yet still slight declines in average daily room rate, we believe that the typical U.S. hotel in 2010 will once again realize a slight year-over-year decline in profitability. But we have become even more confident that the likelihood of a very substantial and attractive turnaround in profits will be seen in 2011 and should persist comfortably through 2013, 2014. With the prospects becoming clearer for an industry turnaround, we ask ourselves the question, what better time to be thinking about investing in hotel real estate? Shown here is the cycle of real estate emotions that we borrow from our friends at Colliers International. It was just 3 short years ago that arguably, and in hindsight, the industry was at its point of maximum financial risk. Cap rates were low, asset prices were high, and prices paid and leverage taken were at their peak. It's well known and it's been well documented in the interim as far as what's happened with the current industry downturn that has persisted to record lengths and depths, that the turmoil today is pervasive. We think that then suggests that perhaps that really is the point of maximum financial opportunity. We are confident that hotel incomes will begin to increase in 2011 and should persist at a very attractive rate well beyond. This suggests that the opportunity to invest capital in hotel real estate will likely yield attractive rewards in the years ahead. Thank you once again for your time.